Did you know FHA is starting to clamp down on the riskiest loans that they back? Watch Tom's Take to find out more. FHA broke news on Monday in the Wall Street Journal and a ton of other news outlets that they're going to start flagging some loans as high risk. The ones they're going to start flagging are for borrowers with low credit scores or with high payments relative to their income. And they're going to put these people through a more rigorous manual underwriting process. So what does this mean and what's the criteria? So FHA, as a background for those of you that don't know, they try to boost home ownership by insuring loans to borrowers with less than stellar credit, often in the low sixes. Those are kind of the numbers that they look at. And all of a sudden, FHA is now going to start tightening standards that could mean fewer first-time buyers are able to get mortgages. Based on the research in the article, roughly 40 to 50,000 loans a year are going to be affected, or 4 to 5% of the FHA insured mortgages. So not a huge percentage. And what I see happening here is that this is kind of a turnaround or an about-face from the 2016 decision that FHA made to loosen underwriting standards. FHA removed a rule back in 2016 that required manual underwriting with credit scores below 620 and debt-to-income ratios above 43%. So it looks like they're kind of going the other way on this. So the pendulum is swinging back. And really, the question is, what does this mean for buyers and sellers? So my view on this is these are people that probably shouldn't be buying homes in the first place, or if they are, they need that manual underwriting so someone can see a gray area in their situation. Low credit scores like that and high debt-to-income ratios are what got the country into the mess and got the whole mortgage industry into that mess that happened and culminated in 2008. So seeing it's only a 4 to 5% of the volume is getting affected here, and also knowing that FHA has raised their mortgage insurance premiums over the past couple years, which has caused a lot of buyers to go with lower down payment conventional loans, specifically a 5% conventional loan, or they go with PHFA loans, which you only need a 3.5% down payment. So there are other options out there, and I don't see this having a major effect for sellers or for buyers unless you're that buyer that maybe shouldn't be buying a home in the first place. You need to work on your credit score more, save a little more money, or pay down some debt before you buy something that's going to be the biggest financial purchase of your life. So my view on this is that not a bad thing, not that I'm risk averse, I just see this as contributing to the long-term health of the housing market. You got questions about this, ping me on social. Otherwise, I'll be back next week.